Imagine running a massive industrial manufacturing company right now. Just picture it.
Right, in this current environment, yeah.
Exactly. You sell fewer products this quarter than you did like a year ago. You're dealing with fewer customers overall.
And don't forget the supply chain.
Oh yeah, the supply chain is a nightmare. You're facing these incredibly volatile, sometimes just skyrocketing prices for raw aluminum, plus the petrochemicals you actually need to run your plants.
Which are completely unpredictable right now.
Totally. And then, to top it all off, your primary market, which is commercial real estate construction, has essentially just, well, stalled out.
Crushed under the weight of high interest rates.
Exactly. So, the logical assumption there is that your earnings report is going to be an absolute bloodbath.
Oh, a total disaster. You'd expect terrible numbers.
Right. But yet somehow, despite shrinking sales and soaring costs, you report a year-over-year increase in your earnings per share.
It's wild to see on paper.
It really is. So today, we are tearing apart the Q1 fiscal 2027 earnings call for Apogee Enterprises. Ticker symbol is APOG for those following along. We're going to figure out exactly how they pulled off this financial illusion.
Because it really does look like an illusion at first glance. I mean, it's the kind of earnings print that just forces you to read the footnotes like 3 times.
Yeah, you have to dig deep.
Because in heavy manufacturing, and specifically the architectural materials sector that Apogee really dominates, the laws of corporate physics are usually pretty unforgiving.
Volume drops, margins collapse. That's usually how it goes.
Exactly. But what we're seeing here is a management team aggressively manipulating the variables that they can control, to offset a macro environment that is just entirely out of their control.
Which is exactly why we're diving into this today. So welcome everyone to a very special Talk Ticker style edition of our deep dive. For you, the listener, the mission today is straightforward.
No fluff today.
None at all. We are taking Apogee's Q1 2027 transcript. We're stripping out all the corporate PR spin and going straight to the data.
Right to the numbers.
Yep. We're going to look at the top line revenue, break down the underlying segment margins, evaluate their forward-looking guidance, and give you an actionable, highly opinionated take on whether this stock, actually deserves a place in your portfolio.
And I think to really understand the numbers Apogee just handed to Wall Street, you have to understand the specific macroeconomic furnace they are operating inside right now.
Furnace is a good word for it.
It is.
Yeah.
Because this company is an absolute giant in the architectural glass metal framing and building envelope space.
Right.
I mean, if you walk past a massive new corporate campus or, a towering hospital wing or a downtown skyscraper, there's a very good chance Apogee's Viricon glass or their architectural framing systems are quite literally the face of that building.
Right. They provide the skin of the building. But nobody is exactly rushing out to build a new 50-story office tower in downtown Manhattan or San Francisco right now. That's just not happening.
No, not at all. The commercial real estate market is going through a historic recalibration, honestly.
Yeah, that's a nice way of putting it.
Right. You have structural shifts in how office space is actually utilized post-2020. That's leading to massive vacancy rates in these major urban cores.
Just empty buildings everywhere.
Yeah, but more urgently, you have the current interest rate environment. Commercial developers rely on debt. That's just a fact.
Right.
They finance these $100 million projects with massive loans. So when the cost of capital effectively doubles or even triples over a few short years, the math on a new development simply breaks.
Oh, it just doesn't work anymore. Let's put some real numbers to that developer math, actually, just to frame the headwind that Apogee is fighting here.
Good idea.
So if a developer is looking at a $100 million project, right, and their borrowing costs go from, say, 3% to 7%.
Which is pretty standard right now.
Right. That is an extra $4 million a year just in interest payments before they've even poured the foundation.
Before a single floor is leased.
Exactly. That fundamentally alters the return on investment. The project either gets delayed or just gets canceled outright.
Yep. The pipeline for new mega projects just dries up entirely. And that is the exact demand environment Apogee relies on to sell, thousands of square feet of premium architectural glass.
Brutal.
And then add to that the inflationary pressures on raw materials. The cost of aluminum extrusions can swing wildly based on global supply chains, tariffs, you name it.
And a chemical side too, right?
Oh, absolutely. The specialized sealants and those low emissivity coatings they use on high performance glass, those are derived from petrochemicals.
So they're tied to oil.
Exactly, making them super subject to global oil volatility.
So it's essentially a vice grip, weak in-market demand on one side, and then volatile input costs on the other.
A total squeeze.
Yeah, which makes the raw data drop from this Q1 report absolutely fascinating. Let's get the headline numbers on the table so we can see how this whole illusion takes shape.
Let's do it.
Okay, for the first quarter of fiscal 2027, Apogee reported net sales of $342.7 million. That is a 1.1% decrease compared to the exact same quarter last year.
So the top line is factually shrinking.
Factually shrinking, they are moving less product.
Which, perfectly aligns with that macroeconomic vice grip we just talked about.
Right, but, and here is the curveball, their adjusted diluted earnings per share actually tick up. It went up 1.8% to 57 cents.
Which is wild.
It is. And that metric actually beat Wall Street's consensus expectation, which was sitting at 56 cents.
A beat on shrinking sales.
Yeah. And even more striking, their reported operating income jumped from $6.9 million the prior year period all the way up to $18.8 million.
Wow.
I know. That is a massive expansion. It brings their operating margin up by 350 basis points to 5.5%.
It's a jarring set of numbers to process simultaneously, honestly. A shrinking top line, but operating income that nearly triples.
Yeah, and this is exactly where I have to push back on the initial optimism. Because as an investor reading this print, a massive red flag just shoots up.
Oh, for sure.
Right. When a company shrinks its sales footprint but miraculously expands its earnings, you have to ask if the growth is like organic or if it's just accounting wizardry. Like, how do they engineer a 57-cent EPS beat on lower volume?
Well, it's not wizardry, but it is a very distinct flavor of financial engineering that we really need to unpack here.
Okay, lay it on me.
So the transcript explicitly guides us to the source of that EPS bump, and it didn't come from the factory floor suddenly becoming some hyper-profitable utopia, unfortunately.
Okay.
Right. CFO Mark Ogdahl actually noted that the EPS increase was primarily driven by lower interest expense.
Oh, okay. So they paid down their corporate debt or maybe refinanced at a better rate, which means less cash is going to the bank every single month.
Precisely. It's aggressive balance sheet management. Okay.
By reducing the amount of money flying out the door to service debt, their net income theoretically rises, right?
Right.
Which mathematically pushes the earnings per share higher, even if they technically sold fewer square feet of glass.
Interesting. I mean, you're praising them for paying down debt, which sure is generally good corporate housekeeping.
Absolutely.
But couldn't you argue that a company aggressively paying down debt in this manner is doing so simply because they have nowhere profitable to deploy that capital organically?
That is a highly valid critique.
Because if the market was booming, they'd be taking on debt to build new factories, right? Not shrinking their footprint just to save on interest payments. I mean, it feels like a defensive crouch disguised as an earnings win.
It really does.
Right.
And it's the exact reason institutional investors scrutinize these reports way past the headline EPS beat.
They don't just stop at the front page.
Exactly. Yes, it is a defensive posture. It proves the balance sheet is healthy and management is disciplined, but you are entirely correct that it is not a signal of surging market demand.
No. It's a balance sheet victory. It's not an operational triumph. And that distinction becomes glaringly obvious when we look at the profitability metric that actually strips out all that financial structure.
Right. You're talking about adjusted EBITDA. Earnings before interest, taxes, depreciation, and amortization.
Correct. So when you look at adjusted EBITDA, you are isolating the core cash-generating power of the actual business.
The actual operations.
Right. The raw act of buying raw materials, manufacturing architectural products, and selling them. You remove the debt payments, you remove the tax structures, you remove the accounting depreciation of their facilities.
Just the bare bones of the business.
Exactly. And when you look at Apogee's adjusted EBITDA margin for this quarter, the illusion breaks.
Oh, man.
Yeah, the margin actually shrank. It dropped from 9.9% in the prior year down to 9.4%.
Wow, and that 50 basis point drop, that is the real story here.
It absolutely is.
It tells us that the operating margin expansion to 5.5% we mentioned earlier,
Yeah.
that is just masking a fundamental decay in the core profitability of the product line.
Completely masking it.
So what is actually causing that decay? Let's translate this margin squeeze for the retail investor who's actually holding the stock right now.
Okay, it comes down to the brutal reality of fixed versus variable costs in heavy manufacturing.
Which is never pretty when volume drops.
Never. Management specifically called out higher material and freight costs combined with that lower sales volume. And I want to use a mechanical analogy here to really explain why volume drops are just so destructive to industrial margins.
Okay, let's hear it.
Think about the massive furnaces required to manufacture architectural glass.
Right, these are huge facilities operating at incredibly high temperatures.
Massive. A commercial glass furnace requires an enormous, constant supply of natural gas and electricity just to maintain operating temperatures. They're often running 24 hours a day.
You can't really just turn them off for the weekend.
Exactly. It costs roughly the same amount of baseline thermal energy to keep that furnace hot, whether you are pushing 100 tons of glass through it per day or only 50 tons.
Right.
That energy requirement is a strictly fixed cost.
So when your volume drops because commercial developers just aren't building, you are spreading that massive fixed energy bill over a much smaller number of finished products.
Exactly. Your unit economics get totally crushed. Every individual pane of glass suddenly costs you significantly more to produce.
Because the furnace is still running.
Yep, you lose all your economies of scale. And that's before you even factor in the variable costs that are also inflating right now.
Like shipping.
Yeah, the freight costs to ship these massive, fragile panels across the entire country. And of course, the petrochemical costs for the complex sealants and low emissivity coatings that really define modern architectural glass.
Man, so they are just getting hit from every single angle here. Lower volume basically bakes the fixed costs into the margins, and then inflation drives up all the variable costs.
It's a tough spot.
It makes the fact that they still maintained a 9.4% adjusted EBITDA margin seem like, I don't know, a minor miracle of cost control.
It really is a testament to their pricing power and their internal discipline. I mean, they are actively implementing pricing surcharges to pass some of those inflationary costs onto the customer.
But there's a limit to that, right?
Oh, absolutely.
Yeah.
There is a hard limit to what a market will bear. You can only cut costs and raise prices so much before you hit bone.
Right.
At some point, if the macroeconomic volume doesn't actually return, that EBITDA margin compression is going to accelerate.
Which means we can't just look at Apogee as one giant monolithic entity.
Now, you have to break it down.
Right. To really understand how they are surviving this margin squeeze and where the actual risk lies for the investor, we have to look under the hood.
Yes, the segments.
Apogee operates 4 distinct business segments and the consolidated numbers we just discussed. They hide a massive, incredibly volatile split between the divisions that are thriving and the divisions that are just bleeding out.
The segment data is really where the true narrative of this company lives right now, because Apogee's portfolio is pulling in radically different directions. It is a textbook tale of winners versus losers.
All right, let's lay out the raw data, starting with the outright winners. The segment doing the heavy lifting right now is architectural services.
Huge quarter for them.
Massive. This segment saw its revenue jump 8.2% year over year to $115.2 million.
Wow.
And what is really staggering about that number is that it marks their 9th consecutive quarter of growth.
9 quarters.
That is over 2 years of unbroken top-line expansion right in the middle of a commercial real estate recession.
It's incredible. And to understand why services is succeeding while the rest of the market struggles, we really need to define what they actually do.
Yeah, clarify that for us.
The services segment doesn't just, manufacture the glass or the aluminum framing. They are the installation and project management arm. They are the boots on the ground, coordinating the incredibly complex logistics of getting these building envelopes actually installed on the job site.
So it's the difference between buying a car engine and hiring a mechanic to install it.
It's even more complex than that, honestly. Think about the logistics of installing custom 10-foot multi-layer glass panels on the 30th floor of a high-rise in the middle of downtown Chicago traffic.
That sounds like a nightmare.
It is. It requires specialized engineering, union labor coordination, crane logistics, and incredibly precise scheduling.
Right.
Developers are willing to pay a heavy premium for a service provider who can guarantee the building envelope is sealed correctly and on time. Because any delay on the skin of the building delays all the interior work.
Oh, that makes total sense. So their expertise in execution is sort of insulating them from the macro downturn.
Exactly.
But, what gives me the most confidence as an investor looking at this specific segment isn't just the backward-looking revenue. It's the forward-looking visibility.
The backlog.
Yes. The data drop revealed that the architectural services backlog stands at a massive $734.5 million.
That's a huge number.
It is. That is up 8% year over year and up 6% sequentially from just the prior quarter.
That backlog number is arguably the most bullish data point in the entire earnings print. I mean, in the construction industry, backlog is contracted future revenue.
It's money in the bank, essentially.
Pretty much. It means the bids have been won, the contracts are signed, and they have $734 million worth of installation work lined up in the queue waiting to be executed and built.
It's an ironclad safety net.
It is absolute visibility. The fact that their backlog is growing sequentially means that despite developers hesitating on new starts, Apogee's services segment is still aggressively winning market share on the projects that are moving forward.
Wow.
It guarantees a steady stream of cash flow from this division for the next, 12 to 18 months, regardless of what the Federal Reserve does with interest rates next week.
Okay, so services is clearly the anchor here. Now, the second winner of the portfolio is the performance surfaces segment.
Yes.
Revenue here increased by 4.9% to $44.3 million. The transcript noted this was driven by both higher volume and favorable pricing. Now, their adjusted EBITDA margin did compress a bit from 18.8% to 14.8% due to those input costs we talked about, but capturing nearly 5% top-line growth is a clear victory.
Performance Surfaces is a really fascinating, highly specialized division. They aren't primarily wrapping office towers.
Hey, what are they doing then?
They are dealing with custom-coated glass and acrylics for niche applications. We are talking about non-reflective display glass for museums, high-end architectural signage, and specialized retail displays.
Okay, which are entirely different end markets than commercial office space.
Completely different.
Right, because a museum renovation or a high-end luxury retail build-out isn't necessarily correlated to the vacancy rate of a standard Class A office building downtown.
Exactly. It's a diversification play that is currently paying off. And crucially, CEO Donald Nolan emphasized that they implemented specific price increases and surcharges during this quarter within this segment.
To combat the inflation?
Right, to combat the material inflation that's crushing that margin.
But there's a lag effect there, right? I mean, you announce a price increase today, but you have to honor the quotes you gave to customers 3 months ago.
Correct. The margin compression down to 14.8% reflects the higher material costs hitting the books today against revenue from orders placed before the price hikes went into effect.
Okay.
Management expects those pricing actions to really begin flowing through to the bottom line in the coming quarters, which should stabilize and potentially even repair that margin damage as the fiscal year progresses.
All right, so services and surfaces are holding the line. They're doing great. But now we have to pivot to the losers.
This is where it gets tough.
Yeah, this is where the transcript gets incredibly gritty. The margin squeeze we talked about earlier is inflicting severe pain in the remaining two segments. Let's start with the architectural metals.
Okay.
Revenue for the metals segment came in at $122.4 million. That is a decline of 4.8%. Management was pretty blunt. They blamed lower volume. They're simply moving less aluminum framing. But now here's the twist. There is a massive, highly counterintuitive twist in the data here.
This is honestly the operational highlight of the entire report.
I agree, because despite revenue dropping nearly 5%, the adjusted EBITDA margin for the metals segment actually expanded in a huge way.
Huge.
It jumped from 7.3% in the prior year all the way up to 11.2%.
Which is incredible.
How do you mathematically expand your margin by nearly 400 basis points while your sales volume is literally shrinking?
Right.
In the transcript, CFO Mark Ogdahl attributes this entirely to productivity improvements and cost savings from an initiative called Project Fortify Phase 2.
Yeah, Project Fortify Phase 2. It sounds like a military operation, doesn't it?
It really does.
And in corporate terms, it essentially is. It is internal jargon for a massive structural restructuring and cost-cutting initiative.
Okay.
See, when a management team realizes that macroeconomic volume is structurally impaired, like we see here with the 4.8% drop in metals, they know they cannot rely on sales growth to protect their profit.
Right. They can't just sell more.
Exactly. They have to ruthlessly lower their breaking point.
They have to figure out how to make money selling less product.
Yeah.
But I want to dig into the actual mechanics of this because, cost cutting is a generic term that analysts throw around constantly. What does Phase 2 actually look like on the factory floor of an architectural metals plant?
Well, Phase 1 of these initiatives usually targets the low-hanging fruit.
Like what?
A corporate hiring freeze, cutting the travel budget, maybe consolidating a redundant regional sales office. It's surface-level financial trimming.
Okay, the easy stuff.
Right. But phase 2 means they are getting surgical with the actual means of production. In an architectural metals facility, you are dealing with massive aluminum extrusion presses, anodizing lines, and really complex painting operations.
So where do they actually find the savings?
They look at the physical layout of the factory floor. If a piece of raw aluminum has to be transported, say, 500 feet across the plant between the extrusion press and the painting line, they spend the capital to physically move the machines closer together.
Just to save transport time.
Yes. To shave 10 seconds off the cycle time and reduce forklift labor, they analyze the changeover time on their extrusion dies. If it takes 2 hours to retool a machine for a different architectural profile, they implement lean manufacturing protocols to get that changeover time down to 45 minutes.
Wow.
That increases the uptime of the machine.
So they're essentially squeezing every single ounce of wasted movement and wasted time out of the process.
Exactly. And they're also aggressively renegotiating supplier contracts to mitigate the volatility of raw aluminum pricing, and automating specific finishing processes to reduce overtime labor hours.
Just attacking it from all sides.
Right. When you aggregate hundreds of these micro-efficiencies across multiple facilities, it fundamentally alters the cost structure of the segment.
And the results are undeniable. Taking an EBITDA margin from 7.3% to 11.2% in a declining volume environment is exceptionally difficult.
Extremely.
It demonstrates that this management team isn't just, complaining about high interest rates on the earnings call. They are actively controlling the variables they can control.
And here is the long-term bullish takeaway for the investor. By executing Project Fortify Phase 2 right now, they have turned the metal segment into an incredibly lean, efficient machine.
Right.
Right now, they are operating in a depressed volume environment. But eventually, the macro cycle will turn, interest rates will stabilize, and commercial development will resume.
It has to, eventually.
Exactly. And when that volume returns and top-line revenue accelerates, it is going to flow through this newly lowered cost structure. The operating leverage will be massive, and that 11.2% margin has the potential to explode upward.
I love that. They trim the fat to survive the winter, so when spring comes, it's all pure muscle.
That's a great way to put it.
But if metals is a masterclass in successful cost-cutting, our final segment, architectural glass, is a story of severe, unrestrained bleeding.
It's bad.
This is the flagship division, operating primarily under the Viracon brand, and the numbers are just brutal. Architectural glass revenue was $67.7 million, which is a 7.6% decrease year over year.
Ouch.
And unlike the metals division, they could not save the bottom line here. The glass segment's adjusted EBITDA margin get absolutely decimated. It plummeted from 18.3% down to 8.7%.
I mean, a margin cut in half in a single year. It is a perfect storm of macroeconomic headwinds concentrating their force on a single product line.
Let's unpack the why behind this collapse. Because we know volume is down because developers aren't building office towers, sure. But you can't lose 1,000 basis points of margin on a 7.6% revenue drop alone. There has to be something fundamentally broken in the product mix.
There is, and the transcript explicitly highlights it. Management noted, quote, lower demand for premium product offerings.
Interesting.
To understand this, we have to look at the psychology of a commercial developer operating in a 7% interest rate environment.
Let's go back to that developer math.
Exactly. So a developer has a massive project underway, maybe a corporate headquarters. They are getting crushed by financing costs, and their contingency budget is just evaporating.
But they still have to finish the building.
Right. They still have to put glass on the building to finish it. But instead of authorizing the purchase of Viracon's ultra-premium dynamic electronically tinting glass, or their highly complex acoustic insulating glass, which, by the way, carry massive profit margins for Apogee.
Like the good stuff.
The developer value engineers the project.
Meaning they cheap out.
They totally cheap out. They tell the architect, strip out the premium specs, give me the baseline standard low emissivity glass that meets the minimum building code so we can just get this building sealed and open.
Wow.
So Apogee is not only selling less overall square footage of glass, but the square footage they're selling has shifted dramatically from high margin, highly engineered premium products to lower margin, commoditized baseline products.
It's a massive negative shift in the product mix. That's a double whammy.
And we have to make it a triple whammy, actually.
Oh boy.
Because we have to bring back the furnace analogy. At the exact same time their volume is falling and their product mix is degrading, the raw input costs to operate those massive glass furnaces are incredibly volatile.
The natural gas.
Energy costs, petrochemical coatings, the underlying cost of goods sold is relentlessly pressuring that shrinking revenue base. That triple combination, lower volume, negative product mix, and input inflation is how a healthy 18% margin violently compresses to single digits.
Which presents management with a pretty serious existential crisis for their flagship division. I mean, they cannot simply wait for the Federal Reserve to cut interest rates to save the glass segment.
No, they can't.
And they clearly know this, because hidden in the transcript is a major personnel announcement. They just brought in a new president specifically to take over the architectural glass segment, a guy named Chris Eade.
This is a critical pivot point for the company. When a segment's margin gets cut in half, you don't just tweak the marketing budget, you bring in a fixer.
A fixer?
Yeah, and Chris Eade's resume, as outlined by CEO Donald Nolan during the Q&A portion of the call, is highly specific to this exact type of operational crisis.
Yeah, Nolan gave some extensive background on Eade, mentioning his 20-year history in strategy, M&A, and P&L responsibility. But his real credibility within Apogee comes from his previous role, right? Eade was the primary integration architect behind their highly successful UW Solutions acquisition,
which they acquired and integrated into the Performance Surfaces segment, the division that is currently seeing that 5% top-line growth.
Right. Nolan explicitly stated that Eade was the operator who went in, took the UW Solutions asset, and engineered the integration so perfectly that it hit its first-year financial expectations flawlessly.
That's rare.
It is. But how exactly does an integration wizard fix a bleeding glass manufacturer? What is his playbook here?
An operator like Eade looks at a manufacturing business as a series of friction points. When you integrate an acquisition, you map the supply chains, you consolidate purchasing power, you align the IT systems, and you force the newly acquired entity to adapt to a leaner corporate standard.
Standardizing everything.
Exactly. Nolan stated that Eade's mandate for the glass segment is to lead a performance improvement plan focused on 3 specific pillars: increasing order rates, enhancing operational productivity, and strengthening cost management.
So he is basically being deployed to execute a Project Fortify style restructuring on the glass division.
Exactly. He will analyze the Viracon manufacturing footprint. Are there redundant facilities? Are there product lines that are simply too unprofitable to continue manufacturing?
Right, time to trim the fat.
He will likely streamline the premium product offerings and aggressively attack the supply chain costs. Management is basically deploying their most proven internal operator to stop the bleeding.
Okay, that provides a huge degree of confidence that management is proactive. But as an investor, I have to draw a hard line here. Cost-cutting, restructuring, bringing in a fixer. These are all defensive moves.
They are.
They protect the downside. They might stop the margin from falling to 5%. But Chris Eade cannot magically force a commercial developer to finance a new office tower. You cannot shrink your way to long-term exponential growth.
You absolutely cannot. Cost-cutting is a bridge. It gets you across the valley of a macro downturn. But eventually, you have to find actual top-line growth on the other side.
Which transitions us perfectly into the most crucial, forward-looking part of this entire earnings analysis. Because Apogee's management clearly recognizes that the cyclical commercial construction market is broken right now.
It's totally broken.
So instead of waiting for it to heal, they have decided to buy their way into a fundamentally different, significantly more stable market. Let's break down the massive news regarding their forward guidance. The Kalwall acquisition.
Ah, yes. This acquisition fundamentally rewires the long-term investment thesis for Apogee Enterprises. It is the offensive move that complements all the defensive restructuring we just discussed.
Let's look at the hard data surrounding the deal. Apogee announced they are acquiring a company called Kalwall, with the transaction expected to close in early July. From a pure numbers perspective, it's a massive injection of revenue.
Massive.
Management projects that Kalwall will contribute approximately $85 million in revenue over its first 12 months under the Apogee umbrella.
To put that in perspective, Apogee's total Q1 revenue was around $343 million. Adding an $85 million annual run rate business is a highly material expansion of their top line.
It's huge.
It immediately offsets the organic volume declines they are suffering in the glass and metals segments.
And it isn't just empty revenue designed to inflate the top line either. CFO Ogdahl provided specific margin guidance for the acquisition. He noted that Kalwall operates with an initial adjusted EBITDA margin of approximately 15%.
Which is the critical data point here. Remember, Apogee's consolidated adjusted EBITDA margin right now is struggling at 9.4%.
So buying Kalwall is immediately accretive. The second the deal closes and the revenues combine, the higher profitability of Kalwall pulls the overall average margin of the entire corporation upward.
It immediately upgrades the quality of their earnings. But the ambition doesn't start at 15%. Management stated they are targeting a long-term margin rate of 20% for Kalwall by fiscal 2029.
20%.
And they plan to achieve that by extracting roughly $4 million in operational synergies.
Okay, let's translate synergies for the listener, because often that just means firing the redundant HR and accounting departments of the acquired company. Is that where the $4 million is coming from?
There is always some administrative overlap, sure. But in heavy industrial acquisitions, the real synergy is found in the supply chain.
The purchasing power.
Right. During the Q&A, management heavily implied that the bulk of these savings would come from raw material purchasing power. Apogee is a massive institutional buyer of aluminum framing, glass, and chemical sealants. Kalwall, as an independent company, bought similar materials but at a much, much smaller scale.
Oh, I see. So once Kalwall is under the Apogee umbrella, Apogee's procurement team can go to their aluminum suppliers and say, hey, we are now bringing you 20% more volume across our entire portfolio. We demand a significant volume discount on the price per pound.
Precisely. You immediately lower Kalwall's cost of goods sold simply by applying Apogee's massive purchasing leverage. That is how you drive a 15% margin up toward a 20% target over a couple of years. It is textbook M&A execution.
Okay, the financial modeling on the deal looks pristine. It's accretive, that offers synergy, it boosts the top line. But I want to spend significant time talking about what Kalwall actually manufactures.
This is the best part.
Because I read a quote from CEO Donald Nolan describing the strategic rationale for the deal. And frankly, it sounded like he was playing corporate buzzword bingo. I need you to translate this for me.
All right, read the exact quote from the transcript. Let's break it down.
Okay. Nolan stated that Kalwall, quote, expands our presence in attractive, faster-growing areas of the building envelope market, particularly in daylighting solutions that are engineered specification-driven and aligned with energy efficiency trends, unquote.
Wow, okay.
Yeah. There is a massive amount of jargon layered into that sentence. What exactly is a specification-driven daylighting solution?
That specific phrase is the golden ticket for the retail investor trying to understand the future of this company. Let's split it into two distinct concepts, starting with the technology itself, daylighting.
I mean, I assume daylighting just means putting a window in a wall so the sun shines in, right? Apogee already does that with Viracon glass. Why buy a whole new company to do it?
Because standard glass, even high-end standard glass, has massive physical limitations. When you put a giant, clear pane of glass in a building, you let in light, but you also introduce severe problems.
Like what?
Well, you let in harsh, blinding glare that makes it impossible to look at a computer screen. But more importantly, standard glass is terrible at thermal regulation.
It leaks energy.
Exactly. It lets the expensive air conditioning bleed out in the summer, and it lets the freezing cold radiate in during the winter.
So traditional windows are essentially massive holes in a building's energy efficiency envelope.
That's a perfect way to describe it. Kalwall does not make traditional glass. They specialize in highly engineered, insulated, translucent building panel systems. They use lightweight fiberglass, reinforced polymer faces, bonded to an aluminum grid, and they're often filled with advanced insulation like aerogel.
Okay, aerogel. That sounds like aerospace engineering, not a window.
It performs like it, honestly.
Yeah.
These panels diffuse natural sunlight perfectly. They scatter the light deep into the interior of a building, eliminating glare and shadows. Yeah, providing soft, natural illumination that drastically reduces the need for artificial electric lighting during the day. And because they are packed with aerogel or other advanced insulators, their thermal resistance is vastly superior to traditional glass.
So they are actively lowering the building's massive electricity footprint by replacing artificial light and reducing the HVAC load.
Yes. Think of a modern high school gymnasium, a regional hospital atrium, or, a civic transit center.
Places that need a lot of light.
Exactly. You want massive amounts of natural light for the occupants' well-being, but you cannot afford the glare or the massive heating bills of standard clear glass. Kalwall provides the perfect technological solution.
Which perfectly aligns with the energy efficiency trends Nolan mentioned. But that brings us to the second and arguably far more important part of the phrase, specification-driven. Why does it matter how the product is specified?
Because it fundamentally changes the sales dynamic and the profit margins. We need to contrast this with how Apogee normally sells commercial glass.
Okay, how does that work?
Standard glass is often sold in a highly commoditized bidding war. An architect designs a generic office tower, notes that they need 50,000 square feet of curtain wall, and the developer puts the contract out to bid.
And then it's just a price war.
Right. Apogee bids against 3 competitors, and the developer often simply chooses the absolute cheapest price per square foot.
It's a race to the bottom, which is exactly why the glass segment's margins are getting crushed right now when volume is low.
Precisely. You are fighting over pennies. But specification-driven products operate in a completely different reality.
How so?
Kalwall's translucent panels are so uniquely engineered. Their specific thermal properties, their exact light diffusion metrics, their structural weight, that an architect cannot just draw a generic square on a blueprint and put it out to bid.
Because the engineering of the entire building relies on Kalwall's specific metrics.
Exactly. If an architect is designing a new high school and trying to achieve a strict LE energy certification, they calculate the entire HVAC system based on the precise thermal resistance of Kalwall's panels. Therefore, the architect writes Kalwall's proprietary product into the actual blueprint by name from day one. They specify Kalwall.
That is incredible.
It is. Once you are specified into the initial architectural blueprint, your revenue is practically locked in years before the ground is even broken.
Because they can't change it later.
Right. When the developer hires a general contractor to build the school, that contractor cannot legally swap Kalwall out for a cheaper generic competitor because a cheaper alternative would fail the thermal engineering requirements and violate the building code.
So you completely bypass the race to the bottom bidding war. You are woven into the structural DNA of the project. That makes the revenue incredibly sticky and highly defensible, which justifies the 20% margin target.
It creates a massive moat around the product. And look at the end markets management explicitly called out for Kalwall: education, healthcare, civic, and institutional buildings.
Right, which are the exact opposite of the dying commercial office space market.
Exactly. A state government is still going to issue municipal bonds to build a desperately needed new high school or expand a regional hospital wing to meet demographic needs, regardless of whether the local corporate office park is sitting 40% vacant.
Because they have to.
Yes. These institutional markets are funded by tax dollars, federal grants, and state budgets. They are vastly more stable, highly predictable, and counter-cyclical compared to corporate real estate.
This is why the acquisition is a masterstroke. Apogee is actively buying their way out of a volatile, bid-driven commercial glass bloodbath and buying their way into sticky, architect-specified, government-funded institutional projects. It completely changes the risk profile of the company.
It is a textbook example of using your balance sheet to upgrade the quality and durability of your earnings.
Okay, so with all this overwhelmingly bullish analysis about Kalwall, the $85 million in new revenue, the immediate margin accretion, the sticky demand, I looked at the updated full-year guidance management provided, and I found a massive glaring nuance that seems to contradict everything we just said.
Oh, what stood out to you in the guidance?
They updated their net sales guidance to account for the acquisition. On a standalone basis, Apogee had originally expected $1.38 billion to $1.43 billion in total sales for the fiscal year. To include Kalwall, they raised that guidance by exactly $50 million across the board, establishing a new range of $1.43 billion to $1.48 billion.
Right, reflecting the new revenue.
That makes sense. They added Kalwall's projected revenue. But their adjusted EPS guidance, the actual earnings per share they expect to deliver to the retail investor by the end of the year, stayed exactly the same. They maintained it at $2.7 to $3.25.
Oh, you were asking where the profit went.
Exactly. If they just bought a highly profitable company that is immediately accretive to their margins and adds $50 million in revenue to the back half of the year, why didn't their earnings per share guidance go up by a few cents? What is the hidden cost eating the profit?
That is a phenomenal catch, and it brings us right back to the very first topic we discussed today: the debt reality of corporate acquisitions in a high interest rate environment.
It always comes back to debt.
It does. Kalwall is an incredible strategic asset, but Apogee didn't get it for free. They had to utilize their existing cash reserves and tap into their credit facilities to finance the purchase price. And borrowing money in 2026 is extremely expensive.
So the new interest expense is eating the new profit.
Exactly. CFO Mark Ogdahl explicitly points this out in the transcript to manage expectations. He noted that to factor in the financing for the Kalwall acquisition, Apogee's full-year interest expense guidance is jumping from their previous estimate of $10 million up to $14 million.
So they are taking on an extra $4 million in interest payments this year just to fund the deal.
Yes. So while Kalwall will be generating millions in new operating profit from those high-margin panel sales, the immediate cost of the new debt essentially cancels out the immediate earnings upside for this specific fiscal year.
The math zeroes out.
Right. The new profit from Kalwall is being entirely consumed by the new interest payments on the Kalwall loan. That is the mechanical reality of why the EPS guidance remains flat.
Now, as an investor, I have to ask, is that a red flag? Are they over-leveraging themselves? Are they putting the entire company at risk just to buy top-line growth?
That is the most important question to ask when a company takes on debt for M&A. But the transcript gives us a very clear, highly reassuring answer. Apogee's balance sheet remains incredibly safe even after absorbing the Kalwall purchase.
Okay, good.
Ogdahl reported their consolidated leverage ratio at the end of the first quarter was sitting at just 1.3 times.
Let's define the leverage ratio for the listener because it is the ultimate measure of corporate safety. A leverage ratio of 1.3 times means what, mechanically?
The consolidated leverage ratio measures a company's total outstanding debt against its annual adjusted EBITDA, its core cash-generating power.
Right.
A ratio of 1.3x means that if Apogee took every single dollar of operating cash they generate in a year and applied it strictly to their debt, it would take them exactly 1.3 years to pay off every bank and bondholder completely.
Which, in the grand scheme of corporate finance, is practically overnight.
It is an exceptionally conservative, low-risk leverage profile. In heavy industrial manufacturing, a leverage ratio of 2.0x or 2.5x is considered perfectly healthy and normal.
Right.
Anything over 3.0x or 4.0x is where you start sweating if a recession hits. Sitting at 1.3x means Apogee has a fortress balance sheet. They are severely underleveraged relative to their peers.
And Ogdahl also noted they have, quote, no near-term debt maturities.
Which is the final piece of the safety puzzle. It means they do not have any massive balloon payments coming due in the next 12 to 24 months, but they would be forced to scramble and refinance at today's punishingly high 7% interest rates.
That's a relief.
Their debt is locked in, structured safely, and easily manageable by their cash flow.
Okay, that completely recontextualizes the flat EPS guidance. It isn't a sign of distress or a bad deal. They are consciously choosing to sacrifice a tiny bit of short-term EPS vanity this year in order to secure a massive, transformative, long-term strategic upgrade to their product portfolio.
Exactly.
And frankly, with a leverage ratio of only 1.3x, they still have plenty of dry powder on the balance sheet. If they find another target like Kalwall tomorrow, they could likely secure the financing to buy it without breaking a sweat.
They have the financial flexibility to be aggressive while their weaker competitors are simply trying to survive the real estate slump.
All right, this has been an incredibly deep, granular journey through the data. We have mapped the macroeconomic vice grip, dissected the margin squeeze, praised the brilliance of Project Fortify Phase 2, diagnosed the bleeding in the class segment, evaluated the fixer Chris Eade, and broken down the strategic masterstroke of the Kalwall acquisition.
We covered a lot of ground.
We did. But now, it is time for the main event. It is time to distill everything we have unpacked into the Talk Ticker's actionable verdict.
This is where we take all the variables and assign a thesis.
Exactly. I am pushing you for a definitive stance right now. You are speaking directly to the retail investor who has Apogee, P-Birchie sitting in their portfolio, or maybe they have it highlighted on their watch list. Based on the totality of this Q1 2027 earnings call transcript, the guidance, and the macro environment, is this a bullish or a bearish signal? What is your actionable verdict?
If we meticulously weigh the undeniable short-term macroeconomic headwinds against management's incredibly disciplined execution and strategic M&A, my opinionated take is a split verdict.
A split verdict, okay.
Yes, Apogee is a cautiously bullish long-term hold, but you must maintain a neutral wait-and-see approach for the immediate next quarter.
Long-term bull, short-term neutral. Let's break down the why for both sides because the timeline here is critical. Why are you flashing the neutral caution sign for the immediate short term?
Because the core legacy markets that Apogee relies on are still deeply impaired, and the turnaround is not going to happen next week. The core architectural glass and metals markets are fighting severe ongoing volume declines.
Right. The macro environment isn't magically fixed.
No. Commercial real estate developers are paralyzed by the interest rate environment. The pipeline of new mega projects is dry.
And the commodity inflation, massive swings in the price of raw aluminum and petrochemicals, remains entirely unpredictable.
Exactly. Management is aggressively passing those costs along with pricing surcharges, as we discussed in the performance services segment. But there is an undeniable lag effect.
It takes time.
Right. Those price hikes take months to filter through the backlog and actually reach the bottom line.
And most importantly, management explicitly warned us that the immediate future is going to be rough. We're looking ahead to the second quarter. CFO Ogdahl stated on the call that they expect net sales to be slightly lower and adjusted EPS to be lower on a year-over-year basis.
Furthermore, he noted that the Kalwall acquisition, while brilliant long-term, will not provide a meaningful financial contribution until the second half of the fiscal year due to integration costs and accounting technicalities.
Right.
So Q2 is going to be another gritty, defensive, likely ugly quarter on paper. If you are a short-term momentum trader looking for a stock that is going to pop 15% on a massive earnings beat next month, Apogee is definitively not the play.
Okay, the short term is a confirmed grinding slog. But let's look past the next 3 months. Let's look at the why for your cautiously bullish long-term view. Why should an investor confidently hold this stock for the next 3 to 5 years?
Because this management team has empirically proven they can navigate the storm and control their own destiny. When a management team can execute a restructuring like Project Fortify Phase 2 and successfully expand the metals EBITDA margin from 7.3% to 11.2% while their actual sales volume is dropping nearly 5%, they are proving to Wall Street that they have absolute granular control over their operational cost structure.
They have engineered extreme leverage into the business model.
Yes, they have violently lowered the break-even floor. It means that when the macro environment finally does pivot, when the Federal Reserve eventually cuts rates, the capital markets unfreeze, and commercial developers start pouring foundations again, Apogee's profit margins are going to experience massive, explosive expansion because their fixed cost base is now so incredibly lean.
And the second major pillar of your bullish thesis is the transformation of the portfolio itself.
Absolutely. The Kalwall acquisition is a transformative strategic pivot. They are actively diversifying their revenue base away from the highly volatile, cyclical, race-to-the-bottom commercial office bidding wars.
Right.
They are utilizing their pristine balance sheet to buy their way into steady, high-margin, specification-driven, government-funded institutional spending.
Schools, hospitals, civic centers. They are targeting the exact markets that receive funding regardless of corporate vacancy rates.
And with an elite fixer like Chris Deed taking over the bleeding glass segment to implement the exact same M&A integration and lean manufacturing playbook that made UW Solutions a success, you have the right leadership team deployed to fix the weakest links in the chain.
I think that analysis is spot on. It is a classic narrative of a highly disciplined management team restructuring the ship while the storm rages outside. But I want to add one final, incredibly crucial data point for anyone currently holding the stock, because the wait-and-see period we just described can be psychologically difficult for an investor to endure.
What is the specific data point?
You are literally being paid cash to wait.
Ah, yes.
In the Q1 data drop, buried below the revenue and margin numbers, we saw that Apogee returned a total of $15.3 million directly to shareholders in this single quarter alone. That total was comprised of $9.7 million in open market stock repurchases and $5.6 million in direct dividend payments.
That is vital context for the retail investor, and it speaks volumes about the health of the company. Let's explain why that specific capital allocation matters during a macro slump.
Yeah, lay it out.
When a poorly run company faces a cyclical downturn and their sales drop, panic sets in. A weak management team will hoard every penny of cash, immediately slash or suspend the dividend out of fear, and in worst-case scenarios, they will dilute current shareholders by issuing new stock just to raise capital to survive.
Apogee is executing the exact opposite playbook.
They are aggressively flexing their balance sheet strength. By maintaining and paying out $5.6 million in dividends, they are providing a reliable, steady cash yield to the investor.
Right.
It is management's way of saying, We have the free cash flow to support you. Thank you for your patience while we navigate this commercial real estate trough.
And the $9.7 million in stock buybacks is a fundamentally more powerful financial signal. Let's explain the math of a buyback to the listener. When Apogee uses its own cash to buy back $9.7 million worth of its own stock on the open market, they retire those shares.
They permanently remove them from circulation.
Exactly. And because there are suddenly fewer total shares of Apogee existing in the world, every single remaining share held by you, the retail investor, suddenly represents a slightly larger mathematical ownership percentage of the entire company.
Which means in the future, when the macro cycle turns and Apogee's total net income skyrockets, that massive pile of earnings is divided by a much smaller number of shares. It mathematically supercharges the earnings per share growth.
It does. But beyond the math, it is the ultimate psychological signal for management. By aggressively buying back their own stock when the commercial real estate market is perceived to be at its absolute weakest, management is shouting to Wall Street that they believe their stock is fundamentally undervalued by the market.
They're betting on themselves.
They are looking at their internal cash flow projections, they are looking at the Kalwall synergies, and they are stating with their wallets that they are supremely confident in their long-term trajectory.
So, to synthesize the final bottom line for the listener, yes, the macro environment is incredibly tough. The commercial real estate market is stalled. Q2 is going to be a bumpy, potentially ugly report.
Right.
But this management team is ruthlessly efficient with their operational costs. They are making brilliant, highly accretive acquisitions into stable countercyclical markets. Their balance sheet is a 1.3x fortress, and they are paying you a dividend and buying back stock to increase your ownership stake while you wait for the construction cycle to turn.
That is the fundamental definition of a highly compelling, cautiously bullish long-term hold.
It is the absolute blueprint of a high-quality industrial company successfully weathering a severe economic storm.
All right, that brings us to the end of our deep dive into the data. Let's do a rapid wrap-up of the core themes we extracted today. First, we saw Apogee deliver a surprise EPS beat that was entirely driven by disciplined debt management and cost control, masking a shrinking top line and compressing EBITDA margins.
Yeah.
Second, we tore apart the immense divide in their operating segments. Services is booming with a $734 million backlog. Metals became a hyper-efficient cash machine through Project Fortify Phase 2, and glass is taking a severe macroeconomic beating that new leadership, specifically Chris Eade, is tasked with fixing.
Third, we analyzed the transformative Kalwall acquisition, which strategically trades a minor amount of short-term interest expense for $85 million in long-term, high-margin, specification-driven revenue in the highly stable education and healthcare sectors.
And finally, we established the actionable bottom line. You are being actively paid to wait out the commercial construction slump through aggressive buybacks and steady dividends, solidifying the stock as a cautiously bullish long-term hold. But before we completely sign off, I want to leave you, the listener, with one final, broader thread to pull on your own.
A final provocative thought to reframe the narrative. What is the big picture idea hidden in this transcript?
Apogee is betting millions of dollars that daylighting, these advanced, translucent, incredibly energy-efficient building envelopes produced by Kalwall, is the absolute future of commercial and institutional architecture. But as an investor looking 3, 5, or even 10 years down the road, you need to ask yourself a regulatory question.
This is huge.
As global green building codes become increasingly strict, and as major municipalities begin mandating massive, verifiable reductions in carbon footprints, will architectural daylighting transition from being an aesthetic, energy-saving luxury to a strict, unavoidable regulatory requirement?
That is the multi-million-dollar macroeconomic question. If local and state governments begin legally mandating that all new schools, hospitals, and civic buildings must hit specific natural light diffusion and thermal efficiency metrics in order to lower the building's overall dependence on the local energy grid,
then Apogee's new Kalwall acquisition didn't just buy them a profitable new product line. It literally just handed them the golden ticket to a captive, legally mandated, multi-billion-dollar market.
Incredible upside.
If radical energy efficiency goes from a nice-to-have option for a wealthy developer to a must-have bylaw requirement for every single new building permit, Apogee is perfectly positioned to completely dominate the architectural blueprint.
It completely reframes the long-term potential of the stock. And it's exactly why you have to read past the headline numbers, ignore the short-term macro noise, and truly understand the underlying physics and market dynamics of the products a company is acquiring.
Absolutely. So to you, the listener, keep your eyes on the data. Look past the magician's misdirection on the headline EPS. Watch carefully how the Kalwall integration actually proceeds in Q3 and Q4, and monitor whether Chris Eade can truly stop the bleeding in the Viracon Glass segment. Until the next deep dive, keep digging in the transcripts, keep questioning the consensus, and we will see you next time.